Hello and welcome to the Green Profit Academy Pros podcast. This show digs into the challenges in growing a lawn care and landscape business while maximizing your profit. I'm Christeen Era.
And I'm Steve Bousquet. We are the green industry experts in profit, growth, and leadership.
Good afternoon, Christine. How are you today?
I'm doing good. How are you doing?
I'm good. I'm excited to be recording this podcast. This is a great topic to go over.
Yeah, it's definitely a good topic. It's not one that we come across too often when we start unpacking challenges in a business, but it is definitely, possible, right? It's the other side of the coin. So yeah, I'm interested to kind of dive in and unpack this today and share some good strategies around it and where to look when you're having these issues in your business.
And today's topic is overhead, right? So welcome to today's episode. We're going to be diving into the overhead of a lawn care and landscape business and helping you to understand what is involved in overhead and how you can manage it and maybe be aware of what's involved in it and have you kind of like be aware of how it affects your pricing strategy and how you can control some of it and how it affects your profitability and your bottom line. And maybe if you're falling short with your net income or your profit, how overhead affects it.
Yeah. And the reason I said this was the other side of the coin is because typically when we sit down with small businesses or, businesses in general, they're saying, oh, I don't have enough money. And the main problem that we find is pricing. And there's things that go into pricing. If we unpacked pricing strategy, we're going to be looking at, how much your labor is, how much the materials are, how much the equipment is, like all the things, bringing it in, making sure that your pricing strategy covers all those things. And the other side of the coin is when your pricing strategy is totally dialed in, and yes, you're pricing correctly, but the reason the company doesn't have money is because of the overhead costs. So the other side of the coin, if it's not your pricing, it's your spending.
It's your spend, right? And that's why Christine said, "Hey, what do you want to do on a podcast?" And it was in the middle of a triage coaching program that I've been working with a company, and their pricing they had dialed in, they had great profit margins, but it was their overhead that is the reason that they don't have the cash. So overhead is below the line. So above the line, if you're looking at your profit and loss or income statement, above the line is your direct cost. So what does it cost to produce revenue, right? So those are also called your direct cost or cost of goods sold. So that's going to be the labor, the material, special equipment cost, subcontractor cost to produce the revenue, to generate the jobs that produce the revenue, right? And then overhead is everything below that line. So you have above the line, so that's direct costs, so material, labor, subcontractors, if you're using them, any kind of special fees or equipment to go along with producing the revenue, and like anything special that goes along to produce the cost or produce the job. And then also like costs associated with the labor that produces the revenue, right? So your unemployment, your insurance, worker comp insurance, anything that's associated with labor burden, with the labor that is associated to produce that revenue. So that's above the line. And anything else that does not go with a cost directly related to produce the job is below the line. So that's what overhead is, where it shows up on your P&L or income statement.
Yeah, and when you're thinking of overhead, think about like rent, utilities. Maybe it's office supplies. It could be it's also your administrative. Your non-billable, your non-producing, like producing your services, employees. So it could be your office admin, office manager, your sales team, things like that are going to fall into that overhead cost. So the below the line, like Steve was talking about. It could also be some of your equipment maintenance and repairs, right? It's with your administrative vehicles and whatnot. So the vehicles that are not out in the field contributing to that revenue production of the company. And some of the other things as well that it can include is the liabilities of the company. So does the company have to pay off a credit card? Does the company have a loan? Are there, vehicle loans or equipment loans out there or something where the company has to pay those? So there are going to be other expenses in the business that are those overhead costs that we need to know how much are those, and how regular are they on, do they come in monthly? Is it quarterly? When do these happen? And how much is it?
So if you listen to the podcast on a regular basis, the reason why gross profit margin is so very important, because after we figure out all of the direct costs associated with the job, we're left with gross profit margin. Now, if the gross profit margin is not high enough to cover all of the overhead costs, then we don't have enough for a healthy profit, right? So that's why I said if the gross profit margin is less than 40%, I call that the smoke alarm, right? Because that's telling me we're in trouble. So typically your overhead cost, it also includes, right? Even though it's not a cost, but you have a percentage you want for profit. So if your overhead cost is going to be 30% and you want a 15 or 20% net profit, then you're going to need at least a 45% gross profit margin. If you have 30% overhead, 15% net, you need at least a 45% gross profit. Or if you want a 20% net and you have a 30% overhead, you need at least a 50% gross profit. And 30% overhead would be a very low overhead, very well managed overhead. So typically in the lawn care and landscape business, you're going to have anywhere between 30 to about a 45% overhead. So if you have a 45% overhead and you want a 15% profit, net operating income, you're going to need at least a 60% gross profit margin. So that's why your gross profit margin is so important. And that's why controlling and being aware of your overhead is also important. So we're going to talk about a few ways to control that overhead.
Yeah, and the easiest way to look at it is, I always look at money in a business is they're in buckets, right? So we put them in different categories. So if you have 100% of your revenue coming in, there's going to be a percentage of that, like Steve is talking about, covering your cost of goods sold. So we take that percentage out. And then the rest of that, we're going to say, okay, now we have this percentage that covers your overhead. And then we look at what's left. So that's where, in the book, in the first chapter, I believe, where I looked at the percentage and where a company is just barely surviving, and anything under that 10% that's left on your profit and loss statement, that net profit, that is a fire alarm. That's saying, hey, we have a problem. There's not enough money that's left in the business, because that money has to go do something else. It's got to pay the liabilities of the company, which is not on the profit and loss statement. So if you're looking at your profit and loss statement and you're just getting familiar with these reports and you see the percentage at the very bottom and it says, negative or 10% or somewhere around there, that there are some things that need to be fixed. So just think of, you can't take more than 100 out of 100. We've got to, divide it up evenly. And if it is negative, we have a loss in the company. And if there isn't enough at the end, you also don't have enough cash to pay what you owe on loans or other things on the balance sheet.
Right. And you don't have to remember all the numbers that we're talking about today, but so 10% net or, net income has a job. It has to leave your P&L and has to go over your balance sheet. And now we have to pay for equipment. And the average lawn care business is going to have between a 5% of revenue to 8% of revenue, 5 to 8% in equipment. So that comes out of that net income, out of that 10%. So when you subtract whatever your percentage is out of the 10%, then you're left with that balance of percentage. You also need retained earnings, right? So we need to have some money left in the bank account. So that is coming out of that net income. Then we also have to have any capital improvements, things that you need to improve the business, that comes out of that. Then if there's any other additional equipment, office equipment, other equipment that the business needs. Also, if there's any distributions or bonuses to the owner, that comes out of that account. So if 10% leaves a super thin margin, it doesn't leave much to save in your vaults, right? In case something happens to the business. So, what happens is people start to borrow money and then it gets the snowball effect of debt. So a 10% is, it's a fire alarm. So, and that's the 40% gross profit margin will show up in a lower net. So that's why we really have to pay attention to that gross profit margin up top. And we can also look, at our overhead expenses to see what's going on. So what are some of the things that I notice? We'll go back to overhead, things that I notice right away when I see that they have their pricing, they have a good, healthy gross profit margin, but that they have a low net income. And the pricing margin, their sales per hour is good, the gross profit margin is good. And the first thing usually I see is the ratios. There's some ratio that is out of whack, right? So their office staff is too big, usually is the biggest indicator. So what's the right ratio, right? How much office staff should you have? In kind of the old school way of looking at it used to be like one admin per $1 million. So that was the owner and one admin per $1 million. And now that might even be really one admin to 1.2 to 1.3 million dollars because technology has made admin really more efficient. But when you have like one non-producing revenue owner and two admin at $1 million, that's a ratio that doesn't work because you're going to have $120,000 to $130,000 in admin, plus the owner's taking another $100,000. So now we have $230,000 basically in non-producing expense on $1.2 million, and the ratio's out of whack. So that's usually the first easiest thing to look at. The other thing that I'll look at is some of their other spends, like they're spending, too much on advertising or too much on office expense with subscriptions to computer programs. There's some really fancy high-end computer programs that are specific to the green industry. They're wonderful programs, but they're really meant for $10 million plus landscape companies, not $1 million or $2 million or even $3 million landscape companies. And they'll put on a full-time person just to run this computer program, and they'll hire a consultant to help with the computer program. And it's a really big expense that company just cannot afford.
Yeah. So when I'm looking at an assessment on a company, or I'm looking at these percentages like you're talking about, Steve, and I'll automatically, kind of my go-tos, right? Which is, okay, the too much staff spend, it's too much employees, it's employee heavy, right? Or another thing that I find is inefficiencies. So the employees are doing a lot of manual things that could be automated. I also look at how much, like if they have an internal marketing person, right? I look at, well, how much are you paying this internal marketing person and how much should you spend on marketing, and make sure that those ratios are correct as well, because that could be another bleed. Another big one is equipment, because this industry, they love equipment. And they have equipment that helps, like the team load the trucks or various other things, but it's not exactly out in the field producing revenue. Or if it is out in the field, is it being fully utilized? So making sure that the utilization on the equipment is there and that you're aware of what that is. And the other thing that I find is the loan liability payments. So I've worked with several companies where they're saying, well, I don't know what else I'm obligated for. And they weren't tracking the liability side of these loan payments with the terms of their vehicle loans or their equipment loans. So it was very easy for them to just say, well, we're going to get a new truck or we're going to get a new piece of equipment, and not connect the dots with, well, when we get that new equipment or we get that new truck, that's going to be an extra, $800 to $1,500 a month that's going to need to be paid, in addition to the insurance cost goes up, the maintenance goes up, all these other things. So they were just unaware of how much do they owe after they pay the overhead of the company, like the rent and, payroll and things like that, what's left. So they were in the negative because they had too many expenses, not just, on the profit and loss statement, but setting there over on the balance sheet, those liabilities that they needed. In addition to credit cards, that's another slippery slope where it's like, oh, we'll just use the credit card, right? And yes, it gets you what you need in the moment, but then you're going to have to pay it later. So it's showing up and you're using that material or the gas or whatever, but there's going to be a point where you need to pay that credit card. And that is going to be additional funds that, it's going to come out of the bank eventually.
Yeah, there's always paying now or pay later, but you're going to pay, right? Kicking that can down the road can be very costly. The other is poor expense tracking, failing to monitor spending and identifying waste, right? Buying too much at one time, thinking you're going to save money. We've been guilty of that, buying the whole season's worth of belts and then they get stuffed in a box. And then next year you rebuy another season's worth of belts. And then 2 years later, you have too many belts. You're not using that machine and you try to give them or sell them back. And yes, things can get, I still think we have 2 cases of engine flush that we bought, and you're only doing that once a year. So it's a lot of money sitting on the shelf. And even explaining some of that to people about, buying whole trucks of stone and holding it for 2 or 3 years. That's a lot of money sitting in the back of your shop. So, not buying material to store just because it's easier at the time. It's a lot of money to just to have. The other is mismanaging labor. And one of the things it should really be tracked as non-billable hours, and it should be in overhead. It should be below the line. And people will have, they'll have their crews stay on a rain day and work around the shop, or when it's slow, work around the shop, and they'll leave that above the line in direct labor costs. But that really should be below the line in non-billable hours. It should be an overhead expense. So when you're figuring out your costs, you're paying that hours out of your net profit, your net income. That is actually, capital improvements or maintenance costs. That is not billed to your customers. So that should not be above the line. So that actually could be in that poor expense tracking category. But counting and tracking the non-billable hours, because that's really overhead. So you're paying for that. Your customers are not. Now, if it's maintenance on equipment, it should be maintenance costs. But if it's just to keep the guys busy, that is, non-billable hours, and you're paying for that.
Yeah. All right. So I want to talk about like some symptoms, because I think it's easier to connect with what's happening in my business. How does it show up, right? When we have problems in these areas. And I think symptoms is a good way to look at it, right? So what are you going to start seeing or experiencing when you have overcost issues? And some of these you might relate with, and some of them, maybe you haven't thought of and, connected those dots, which is why we want to go over them. So some of the signs we've kind of already talked about, but I want to go over them directly and, identify them. And one of them, as Steve already outlined, is that low profit margin, right? So you're working really hard and the profits aren't showing up and you're going, where's my money? It says I have this much at the end of my profit loss statement, but where did it go? So that low profit margin is a symptom that the costs are out of control, or no profit margin, at the end of that profit loss statement means they're really out of control. So you're going to feel those pinch points when the overhead costs are too much.
Core Growth Strategies provides business growth management solutions through cloud accounting, bookkeeping, and strategic business consulting programs. Our team works with small businesses in lawn care and landscape and trade industries throughout the U.S. We increase our clients' business acumen by creating business performance transparency through financials and strategic advisement based on industry best practices and benchmarks. Our experienced team provides support, guidance, and coaching, thereby allowing our clients to connect with viable data and discover their own solutions. Core Growth Strategies programs and services are designed to get your business from where it is now to where you have always dreamed it to be. Visit us today at coregrowthstrategies.com and follow us on Facebook, Instagram, or LinkedIn. Don't miss our exclusive limited time podcast special. Just mention promo code GPA Pro to any member of our team during your complimentary consultation, or enter the promo code on our site when you sign up for one of our online programs. That's promo code GPA Pro.
So that is the question is like, and it's so frustrating because your team can do a great job and you can get your pricing dialed in, and where's my money will come into play. And you'll look at that gross profit margin and it should make sense that you should have more money. And we have a benchmarking system we'll use. If you do the benchmarking will say, your net income was $160,000. But you look at your P&L and you're negative 57 because one's an accounting and one's a KPI tracking tool, and two different, one shows one set of reasoning and the other one shows an accounting tool like you would use for the IRS. So one's a managerial accounting tool, one's a tax accounting tool. So the managerial accounting tool is showing you what you generated with your revenue, and the other one's showing taxes. So one reveals kind of a tax truth and the other one reveals managerial truth. And they're like, well, that can't be right. And you're like, it is right. So just revealing the awareness around, you actually did great with your pricing. It was the managerial truth shows that you're just spending too much to get to that, and too much overhead. And it was really with staffing, right? So you have to be really careful with how many people you have. If you have designers and you have field managers, and then you have operations managers, and you have office managers, and your company can't support that, if you have that's a $3.5 to $4.5 million business that I just said. So if I've talked to people who have $500,000 businesses and they have two people plus the owner, and their overhead, they're struggling, and they will for infinity, because that model cannot support that level. It's not their pricing. I don't know how much they would have to charge between 300 to 400 hours if they're only selling, 5,000 or 6,000 man hours a year. That's how much they would have to charge. So that's the other thing is you can literally look at how many man hours you sell a year to produce your revenue and figure out what you need to charge to cover your overhead. And that's what our benchmarking tool does. So there's multiple ways to look at it. And if you want to figure this out, I can work with you on that. But looking at it and being aware of it is really the beginning of it. So if you have too much month at the end of the money, that is a real big indicator.
So we have low profit margin to where you don't have enough money, right? Whether it's like after the cost of goods sold, your gross profit margin, it's too, not where you want it to be, or your net profit margin. The other one is cash flow problem. So this is where you feel that pinch and you're struggling to cover those bills, or you don't feel that the cash is coming in at a steady rate to manage the business, or all the cash comes in, then it's spent. And then you're going, okay, now we need, more work, and you're running out there to get more work. So those cash flow pinches that you're feeling, that's saying that there's too much spend happening in the business. So if you can't pay the bills, or you can't, cover the day to day, then there's too much spend. And the question is where is that spend happening? And the other question is, why is that spend happening? Right. And then when we look at that spend, we want to really cut the spend where it matters and not where it's going to cut the value that you're providing as a business. So, we can cover some strategies in a little bit to talk about that. Another one that will show up where you might start feeling like, oh, well, maybe I need to raise my prices, and that's that push and pull again with that cash flow, the money coming in to pay the bills. You're starting to feel like maybe it's a different problem. I just need to raise our prices. And then also that fear that comes into play of raising the prices of, well, if I do, I'm going to lose those customers. So there's that price pressure or even price anxiety, because I feel that's what it feels like, when we're working with clients and coaching them around price increase, is there's a lot of anxiety around it because one, they need more money, but two, they're afraid that they're going to lose the customers that they have when they increase that price. So that's where the price pressure comes in. Another thing that you're going to see is the difficulty around scaling your business, right? It gets hard to work on the business because you're, breaking your back working in the business. So, and this can really tie into several things, right? Hiring new team members where you're not able to hire the right people. So that could be an area that's eating up your cost in the company, to where you're hiring all the wrong people, and it's really expensive to hire, and it's really expensive to lose someone and then have to hire again. So that can impact the amount of time you have to work on your business, and it can impact where the money's going that you have in your business, because you're just throwing it away hiring the wrong people.
So two things on that, right? First one is if you're trying to implement profit first and it's really difficult to fund all your accounts on a consistent basis, that's an indicator that your spend is off, right? If every time you go to fund it, you're going to move a little bit from this account to fund that account, that's an immediate indicator that your spend is off, right? So you got to get those allocations lined up. You got to get the spend corrected. The second thing that Christine mentioned was the scale, right? I have this graph that shows, since 2001, and the growth was just kind of minimal. And then in 2011, I read a book called Simple Numbers, Big Profit. And you can see the year I read the book, we doubled our profit rate, right? 100% profit increase. And then that went along for 5 or 6 years till we fully implemented profit first. And we were growing at between 2.5% to 5% a year. And then in 2016, we implemented profit first. And then the company exploded in growth, right? And the reason was because the money was always there every time we needed it. We could pay people better. I never had to worry about where the money was, how to get it. And the exponential growth was because the cash flow was there. It was always in the right place at the right time. And you can literally see the date, the year that we implemented Profit First and how it may help the company grow exponentially. So if you're not growing and you're not scaling, and you're struggling with that cash flow, it's the spend and the management of that cash flow.
Yeah, and the other thing I'll say to that, because I've seen this happen as well, is it's the right thing at the wrong time. So I'll see businesses where they'll hire, additional admin people, or they'll, hire a project manager, and they'll say, well, this person's going to run all the work, so I don't have to run all the work. But your business isn't at the level where you should not be working in your business. Like, your business still needs you to be producing a revenue. So that's something that I'll see a lot that has a huge impact on the company, is the owner is paying other people to do jobs that the owner should still do themselves. And the other side of that I'll speak to as well is, and this typically goes hand in hand, when the owner hires somebody to do a job that they don't want to do anymore, and it's not the right time, like the company's not at the right revenue level, something that I'll see happen is they hire somebody to do the job that isn't fully qualified to do the job, or there's no accountability that they're actually doing the job. So the job that they hired them to do is being done part way, and there's no accountability to tie their production and their outcome to the top line revenue and the profitability of the company. So those are other factors that I see show up, is the wrong hire at the wrong time, with the lack of skills and the lack of accountability. And it's a combination of, several of those that will show up when the company is not at the right revenue phase for that to actually happen.
Yeah, up to $1 million, the owner really needs to still be selling and working in the field enough to pay for their own salary. They should definitely have some admin help with billing and that admin help, but they need to be in the field generating at least their own salary and revenue and doing the selling. And then after $1 million, they need to be, if they're not into sales, they need to be, if they have a salesperson, then they need to be generating enough of the revenue for themselves and the salesperson, up to 2 million to 2.5 million. But you can't have a non-working owner and a salesperson. If the owner decides that they're not going to work in the field and have a salesperson, that's probably over 3 million.
Yeah. All right. Another thing that can show up is the strain on loan payments or even making payroll. And this is another reason why I like the basic concepts of Profit First, right? Because it says you should have this percentage for operating expenses, and you should have this percentage, for profit, and you should have this percentage for owner's compensation. Like, what should you be getting paid? Which means you're producing something in the company. And then, there's also the materials and subcontractors. What's that percentage? So it really gives you some great guardrails to say, this is what your spend should be at a basic level. And if you want more detail on, and then what, right? What should I spend? Then I would say go to the scalable growth business model that is unpacked in chapter 8 of the Profit First for lawn care and landscape businesses. Whether you're a trade business, or a lawn and landscape company, these percentages will help you understand what's a healthy spend I should be spending in these other areas of my company. Like, if you're really trying to dive deeper and you have a more complex business model, or you're really trying to understand, where am I overspending? I know I'm overspending somewhere. That scalable growth business model concept is going to give you those percentages of spend while keeping that gross profit margin in that healthy range.
Yeah, know your spend percentages, right? So it's so valuable to know your spend rates and compared to yourself and also compared to the industry, right? So that's why the benchmarking is so important, to know how much you're spending. And also it lets you goal, like, okay, what is my spend in this category? How can I get it down a half a point? How can I work that? Because if I can get it down a half a point, I can move that down to my net and I can pay off debt, right? But if you're just hoping and praying that this year is going to be better, and this is what I hear in the industry, and I did it too. Everything, if I can add 50 more customers, everything's going to be better. If I can add another crew, everything's going to be better. If I can just double my size, everything's going to be better. Well, I will share, if you're not making money now, you're not going to make money at double the size. If you're not making good money now, you're not going to make good money at quadruple the size. And if you're not making money doing what you're doing now, adding a new service is not going to make you the money, right? If you don't have a good way of making money intentionally doing what you're doing now, it will get worse. Actually, it will make the hole either deeper or wider, and it will take longer to dig out. You have to intentionally be really focused about how to make money, and knowing those ratios is the key. Like what's your percent spent on advertising and marketing, and why is it? What was it last year? What was it the year before? What's your return on investment? That's a question that you need to be able to answer. And what's your labor spend to produce your revenue? And why is that? What was it last year? What was it the year before? And can you improve it? How can you improve it? That's a much better question than just adding crews. Because if you don't know those questions, you should not add a crew or a new service. Kevin Kehoe, he's passed away now, he wrote articles for a number of years on why don't start this new service, because this is how long it will take you to get your return on investment. And this is the learning curve that it takes in the investment. But if you do this and that, just change your pricing and increase this, you'll be better off this year. And, it's interesting. And so I approached him at a trade show, and I, congratulated him for writing those articles and putting those in those magazines, because I know the magazines get paid by advertisers who sell all these new services you should be promoting. And I said, that was pretty gutsy for you to write those articles telling people not to do these services when the advertisers are selling stuff, telling them to do the services. And he just turned and looked at me. He's like, I didn't put that together. But he was really doing the industry a service by telling people, don't do that. So, if you're thinking about starting a new service because that's the way to make money, or doubling because that's the way to make money, I will share with you the fastest way to make money is getting your numbers dialed in, your own numbers that you have right now.
So with that, Steve, let's go over some solutions that our audience can use to optimize their overhead costs. So, get those reined in, figure out like, what can I cut? Where are there areas of opportunities, right? And these are solutions. So we went over symptoms. Mm-hmm. What is this going to look like and feel like, right? And we went over what are the things that that we have to look at, like what are the overhead costs versus, our costs of goods sold. And these are going to be some of the things, like some solutions that you can look at to try to get it dialed in. And again, you could always reach out to us. We have that assessment online, a Profit First assessment for you to get started. We also have some Profit First webinars if you want to gain a better understanding of how to implement Profit First in your business. But that assessment is going to let you know, where am I at now and where should I be? And one of the things that is a standard practice, and this is true in Profit First, if you read the book, it says to do this, but also just standard in business practice, right, is to conduct an overhead audit, right? It's not as scary as it sounds. All it means is you are going to review all the expenses in your business in the areas that you spend and figure out, what do we really need to spend and what do we not need to spend? So if we don't know what we're spending, we can't cut some of the fat. So that's all an overhead audit is. It's just an expense review. It's looking at, okay, so what are we spending on memberships? What are we spending on legal fees? What are we spending on office supplies? Why are we spending that much? What about subscriptions? So various things. You want to look through everything in detail and just figure out, what am I spending? And highlight the things that you think that you can cut. So that's what you do. It's very simple. And you're going to find a lot that you can say, I can live without this for right now, or sit down with your office manager and say, hey, I've noticed that we're spending a lot on this. What do we not need to spend? And is there a way we can spend less?
Absolutely. And just knowing what you should be spending. So how much should your rent be for the year, right? 3 to 5%. So if it's over 5% of your annual revenue, you might be spending too much, right? So that's a good number to be aware of. Yeah, that overhead audit is really important. And also seeing how much are we hiding personal expenses in there? Are we driving a $75,000 pickup truck around and calling it a business expense, right? And that's showing up as a business expense because we do drive on a couple of sales calls, but is that really something that we have to have? Is there a bass boat in there? That's not an expense, but I've seen it. So, let's be honest and let's not hide expenses in there. So definitely call it what it is. Do we have a family member who is on our staff that should not be on our staff? That's not uncommon. I would say probably 20 to 25% of family-owned businesses have a family member on the staff that is helping out. And I've done it. I've seen it. It's temporary until it's not. And it's a hard person to get rid of. So until we can't afford it. Sometimes we can, sometimes we can't. So that's another thing to consider. So do the overhead audit. Sometimes you have to shop insurances. And the other thing is sometimes we get stuck with, we think vendors are our friends. And it's very interesting until you shop it around and you find out that your friend was overcharging by 20 or 25% or 50% on certain items. So do your overhead audit. It's not that scary, and see what you can save. And if you can't save, at least you're getting the right price and the right value.
Yeah. All right. Another one opportunity, and I love this one because I love to streamline and I love efficiency and I love, anything that we can automate and all those fun things. So streamline your operations. And what does that mean when we say streamline your operations? This is where you can utilize job management software. And I would have to say, I've looked at a lot of software being in the industry that I'm in as an accountant and business advisor, looking at software in these different industries. The lawn and landscape industry has had some players, join in the game in the last several years that are very efficient in how they're building out their software. I look at their software and I'm like, man, I wish we had this kind of software in accounting, right? It would make everything so much easier. But the technology usage in this industry is an amazing thing. I'm extremely impressed by the software and how they're looking at supporting you all and making your business more efficient. So using that software with scheduling, invoicing, scheduling services, communicating with the team, communicating with the customers, all those things are phenomenal. There's also the GPS tracking for your vehicles. You can reduce fuel costs. You can manage your fleet. There's software out there to do that for you. And any sort of repetitive task that your team, whether they're managing or they are in the office, anything that can save you money. There is a ton of, automation and other things built into these softwares where they could just set it up and it's done for you. And it can really open up some capacity for the team that you do have and save money because the software is doing it. And if you look at the cost on that software, I guarantee the cost on that software is going to be far less than the number of hours that your team is putting in to do these processes manually.
Oh, absolutely. Yeah. Software is going to be way quicker. Another one is to optimize your staffing. So evaluate non-billable roles in the company, ensure that there's no overstaffing or minimize any kind of overstaffing, cross-training employees to increase efficiency and reduce additional hires. So using part-time bookkeepers or the office managers, it could be the phone person, the HR person, the, bookkeeper, the payroll person, until you get large enough you can outsource some until then you can bring somebody in full time. So making sure that you don't have too many people in the office. And again, like what is that size, that one admin to $1.2 million. And then the next admin, then you can outsource until you get to 2 million. Then some of the, things that need to be done. Then when you get to 2 million, you can bring the next person in. And then making sure that owner is at least generating the revenue that the owner is drawing. And when they are selling even up to $2 million. So otherwise the business can't support that and they'll feel the stress.
Mm-hmm. So this is kind of in line with the, the expense review, right? The audit that we were talking about, but we want to look at addressing loan liability payments. So if you're looking at your financials and you're going, we're really heavy on this debt side, some of the things that you can do is refinance loans. So look for lower interest rates, or extend the terms of your loans, right? Maybe consolidating and paying something off faster. When we look at paying off debt strategically, we really want to prioritize those high interest loans first. So you want to, kind of, they call it snowball, right? Where it's like we pay off a loan, then we use that money to pay off another loan that we were paying for that liability. So there's some really good techniques out there and strategies that you can utilize. And the other one, I know this is hard, but sell the equipment you are not using. You can go, to your friend's business and, or go meet someone that has something like this and you can go play with their equipment, like let them pay for it, right? But any equipment that you have that you're not using, sell it. And this will free up that cash flow and you won't have that asset to manage anymore or maintain, which is even more cash that you're spending on that unused equipment or underutilized equipment.
Sell it, no way.
Yes, set it free.
That is funny. Yep, that is so hard to do. All right, improve that tracking, expensing control, like unbudgeted man hours, unused tools, and also maximize equipment utilization. Rent equipment when you need it. Don't buy it. Track return on investment on each piece of equipment. We just repainted my bark blower that I bought in 1999. It looks brand new. I could sell it for 30 grand. That's what I paid for it. But a new one I think is like $110,000 to replace that. How much bark you have to blow to generate $110,000? That's a lot of bark. So interesting. So if if you charge $10 a yard for the machine, you'd have to blow 110,000 yards of bark. And we do 1,000 yards a year.
Yeah, that's a
lot of money. All right. So, track your equipment, make sure you're charging for your equipment. You can use your equipment as a profit center. Schedule regular maintenance on your equipment to avoid costly repairs. One of the things why Z sprays last so long is because we keep them clean every day. They get a quick wash and we blow them off and maintain them on a regular basis. watching how the guys maintain the equipment and letting them know that you're going to wash and take care of it, it becomes company culture, and there's less breakage. We found when we don't wash it and take care of it, we had more breakage, because I think it sends a message that the culture is to who gives a about the equipment,
Yeah.
But when you're keeping it clean and washing it, and you put their names on the equipment and their trucks, everything gets taken care of a lot better.
Yep. A few other things, like Steve already mentioned, like evaluate your marketing spend, right? Don't let the spend of your marketing be driven by your desperation of making more revenue and needing more revenue to cover the costs. I've seen that before. So make sure that you have a budget on your marketing spend, and that you're also tracking your return on investment, because we want that marketing spend to bring something back to the company. So we went over benchmarks in a few episodes ago. If you skipped it, go back and listen to that. We talk about marketing spend and ROI in that episode as well, and what you should get when you're spending money on marketing. Another thing is, and I'm a huge advocate of this, is forecast and plan ahead. Surprise. So budgeting, strategic planning, have some goals. Like, you don't have to have a big lofty strategic plan or goals, but having some sort of projections financially to prepare and manage and maintain your business, just really knowing, okay, we're a business of this size. This is how much we're going to spend on production payroll, on operations payroll, on equipment, on the rest of the operating expenses, and have profit left over. So just getting an idea of how to divvy up all that revenue into the proper buckets based off of your revenue tier. Start as simple as that. I mean, you're going to be doing a lot more than most businesses out there who are just shooting from the hip. And then the other bit of advice I would say is, make sure when you do that you have enough left over for that rainy day fund when emergencies happen in your business, and being able to put a little bit away in that reserve, so you can, when stuff hits the fan, because it's going to, you have some place to dip into to manage those unexpected expenses in the business.
Yeah, it's not a matter of if it's going to hit the fan. It's just a matter of when it's going to hit the fan. I do want to say something about marketing, because here's the thing about marketing. So existing customers are 7 times more likely to buy from you than someone that's never bought from you. So that's 700% more, right? But where do most companies allocate all their marketing and advertising? To people that have never bought from them. So we're not marketing and advertising to the people who are 700 times more likely to buy more products and services. We're spending it, most of us are spending it to people who don't know us. So, we want to allocate at least a 20 to 25% of our marketing budget to our existing clients, existing and past clients. Even if they've asked us, we call them rejects, people that asked us for prices but did not buy, because they are aware of us, and anybody that has ever bought anything from us in the past, right? And then the other thing is even though with all the marketing and advertising, the number one way to get new customers is referrals. So we want to make sure that we're pushing our referrals, asking for introductions and referrals, because in America, that's still 3 times more likely to get a new client from a referral than any other form of advertising. So if we just think about those 2 avenues, that we want to, the 2 most successful ways to get revenue and new clients, referrals from existing customers. And most of us are spending 99% of our marketing budget on not those, on new customers. So spend your time and a little bit of money on referrals and marketing to our existing customers. And that will be a little bit of a gold mine for you. And doing that actually lowered my budget, and also doing pumpkin planning lowered my budget by half, which for me is about $60,000 to $70,000 a year. So over the last 8 years, we'll call it 70. So over $500,000 I saved in marketing. So pay attention to those numbers. It's literally a small fortune.
Yeah. All right. So I would just ask, if you're listening to this and you're feeling any of these symptoms, or, looking at where can I just tighten it up a little bit, just start with one of these strategies that we shared with you and see, what level of improvement that you might have. Maybe you're doing a couple of them, add one more and see, where are you going to tighten up that spend in your business? Because when you tighten it up, that spend turns into profit.
Awesome. That was a good podcast, Christine. I want to thank everybody for listening today, and we look forward to you joining us on the next podcast.
And I want to invite you to look at our show notes, because I have included a tool for you in there. So I have a little checklist where you can take some action. So feel free to click on that link, download the checklist, and this is going to help you audit and streamline your overhead. So it helps walk you through, what do I need to look at? What areas of the company, where are the opportunities? And it's just a little guide that I wanted to provide you all today to use as a tool to get you on the right track with your overhead costs.
Awesome. And if you want to work with us, we do this stuff every day, and you don't have to trudge through it. We can help you really quickly find your way through this stuff. So awesome. We'll see you soon.
Thanks for listening to the Green Profit Academy Pros Podcast,
the show that digs into the challenges of growing a lawn care and landscape business while maximizing your profit.